Mark, it's interesting because as much volatility as we've had in the equity market, we haven't quite seen the same volatility in the treasuries market. Why is that? You would think treasuries would be more affected.
So, Vonnie, I think we've seen a big backup in treasury rates, and so now investors are looking at the U.S. market and seeing much more value. Remember, in the last 7 months, we've seen almost a 1% move in 5-year rates. And so basically, I think at these yield levels, investors are sensing more stability. We're going to get an auction this week, which could be met with decent demand. But at these rate levels, I think the U.S. bond market has definitely become more attractive.
So the U.S. bond market, what about international bond markets, which is where you might be able to pick up a little more yield, right? Has the risk-reward scenario changed significantly in the last just few days?
So not necessarily in the last few days. I mean, demographics, because we have aging populations, the demand for income and bonds is going to continue to be pretty robust. In developed markets, as you know, the yields are very low. They're 0% in Japan. They're basically 0.5% in Germany. And so because of that, the U.S. Interest rates are at very wide levels. In fact, if you look at U.S. versus Germany or U.S. versus Japan, U.S. is at levels we haven't seen in 10, 15 years. And so again, I think the U.S. bond market as well as select emerging market bond markets make sense now in the context of all global bond market yields.
So, Mark, we saw some conciliatory rhetoric from the China leader, though he didn't name Trump or the U.S. specifically. But I'm wondering at what point China does do something like intervene in its currency market or potentially pull back just a little further on bond purchases. Do you see that happening at all?
Well, on the currency, I don't think that's in their best interest. In terms of bond purchases, China has been buying less in terms of the global stock. As you know, the Fed has been the biggest purchaser of treasuries. Japan and China basically own about $1 trillion U.S. treasuries, and we're set to issue more bonds in the market. We're going to be running 5% deficits now as opposed to 3.5%. So clearly, I think these bonds will have to come at lower prices, higher yields. But the good news, as we spoke about, is we've seen this big backup in yields. And so now, potentially as China steps back, other investors like the U.S. insurance industry, U.S. pension funds will want to buy bonds at these yield levels. So the market has become more attractive.